Hey, this is Chris, and in this video I'm going to be talking about the 5 key differences between saving versus investing. And saving, you'd probably typically know as putting your money in a bank account or a term deposit somewhere really safe. Versus investing, I mean, it covers a range of different places you can put your money, whether it's property, shares, or a diversified portfolio or something in between. Now, the 5 areas I'm going to be comparing are returns, how they're different, risk, which is obviously the other side of returns, your time horizon, how that can be different, the liquidity or your availability of getting money out, and then finally the need to diversify or spread the money across different places. To start off with, the similarity between investing and savings is that they're both places to park your money to ultimately grow your money. But that's really where the similarities end, because investing and savings are otherwise quite different ways of getting there. So risk is the first area that you'll notice is quite different. Savings, whether you're putting your money in a high interest account or a term deposit or just a bank account, is known as very safe. You're not going to lose your money, and day to day you're not going to see the money go backwards. Generally, saving is capital guaranteed or something pretty close to that. That's not to say that you're going to keep up with inflation though. So although you've got very little risk of going backwards, you may go backwards relative to the prices of things that you're trying to buy. On the other hand, investing, whether you're investing in property or shares or anything really, what you're likely to see is a lot more variability of returns. So the price of whatever you've bought might go up or down in the short run. Now, that can be quite extreme. If you're just investing in individual shares or something quite speculative, you're likely to see very big gyrations in the price movements. Whereas if you're in something like a diversified portfolio that's quite conservative, the gyrations may not look very large at all. You might see only small ups or downs. But really, whether you're investing in something quite high risk or low risk, there is a level of market risk that you accept when you're investing. That can be controlled, but it's always there. And that's why you're actually earning a higher return. Which gets me to point number 2, which is returns. Now, when you're saving money, the returns you typically earn are in a single form, which is interest. So whether you're investing in a term deposit, high interest savings account, you'll plonk your money in there, and every month you'll get an amount of interest. These days, interest rates are really, really low. So Westpac, for instance, their variable interest rate in their typical savings account is 0.15% per annum, which means to grow $10,000 into $20,000, it will take you just around 280 years. Not many of us have that much time to wait. So savings these days doesn't give you a very good return, and it's very different to when I was a kid using my Dolomite savings accounts and interest rates were much higher, let's say 5 or 6%, and you could actually get a bit of a return. On the other hand, investing, over the long run at least, has earned a higher return than saving, and you actually earn that return in 2 different ways. So you earn the capital return, which is the price of whatever you're investing in going up. So if that's shares, that is the share price is rising, or if it's a property, it's the value of the property rising. And in addition to that, you also earn something called the income return, and that income return comes in the format of dividends when it's shares, or it could be rental income when it's property. So you earn 2 components of return. Those 2 add up to anywhere from, most likely 6 to 12% per year over the long run. So over a very long period of time of 100 years, our share market in Australia has returned about 10.7% per annum. So quite a bit better than cash. But it really varies year to year. So you have years where markets go down, years where markets go up. Really, you have to accept that up and down in order to earn that long-term outcome. The next difference between saving and investing is your time horizon. So savings is a really great option if you need the money really soon. Because of some of those points I made earlier, the money's guaranteed, you know what you're going to have. If you're about to buy a house in 2 months' time and you've got the house deposit ready, you want to have certainty that you still have that house deposit in a couple of months. So investing isn't a good option, because even though over the long run you'll probably earn 10% a year, over 2 months it's anyone's guess where you could go. So if your time horizon is quite short, and generally we would say savings is a better option if you're only looking to use that money in 1 or 2 years, then savings is probably the right option. even though your returns aren't going to be too high. Whereas if you have a bit more time on your hands, even 3 or 4 years could be enough for a conservative style investment portfolio, or probably you need 7+ years if you're investing only in shares. Then investing is a good option for longer term time horizons. And in fact, leaving your money in the bank for longer term time horizons is actually dangerous in itself, because you're falling further and further behind the costs of things that you might want to buy in the future. So time horizon is the third. Then there's the daily liquidity or access to that money. Now, when it comes to savings, generally you have pretty good access to that money. So a high interest savings account or a bank account, you can pull out the money whenever you need. Term deposits are a little bit different, because your money's locked away for usually a matter of months, maybe 3 or 6 or 9 or 12 months. So you earn a slightly higher return, but the sacrifice you make is you can't access the money very soon. So where the interest rate on a savings account now might be 0.15%, you might get 0.4% from a term deposit, but you can't touch the money. On the other hand, investing again has a wide variety of ability to access your money. So if you're investing into, let's say, a residential property, then generally it takes a bit of time to put the house on the market and sell it and actually realize some money out of that investment. And so that's on the less liquid side of investing. Whereas there's other ways of investing, like if you're investing into ETFs or a diversified portfolio on the ASX, where you can get the money really quickly. So you can sell, and within a couple of days, the money has all settled and is back into your account. So I would say both savings and investing allow for different levels of liquidity or access to your money, and it's something that's quite important to consider. Whether you're going for savings or term deposits on the saving side is short or longer term, or whether you're investing into something listed on the ASX that you can get your money out quickly, or some sort of unlisted asset like property, which it can take a little longer to access your money. Now, the final difference, I think, between saving and investing is the need to spread your money or diversify. So when you're putting your money in the bank, look, the financial crisis might have been the exception to this rule, but generally your money's pretty safe and you don't need to spread your money across lots of different places. Now, I know a lot of Aussies, and particularly pensioners, when the financial crisis hit and the government only guaranteed your first $250,000, they diversified and spread money across lots of banks. But that's pretty uncommon, and generally you can be pretty confident that your money's safe and you don't need to spread it out. Investing, on the other hand, is quite different. If you're only investing into one stock or a handful of stocks, it's actually extremely risky. So just having some Telstra and Westpac and Commonwealth Bank shares in your investment account is not like just putting your money in a few bank accounts. From a savings perspective, it's really risky when you're investing, because only a small number of shares actually drive all of the market returns, and you're quite likely to lose money if you're only investing into a handful of companies. And so when it comes to investing, it's really critical that you spread your money across a range of different companies, as well as a range of different countries and a range of different asset classes. And what that does is it helps to protect you from different market outcomes, whether you have high inflation or low inflation, or a good year in markets or a bad year in markets. Diversification helps to smooth those returns, which is important when you're investing and not really that important when you're saving. So in my mind, they're the 5 key differences between saving and investing. Really they're good for different people at different points in their life, or saving up for different goals. But when you're deciding whether to save or invest, they're the factors I think you need to consider in order to make a great informed decision.